What if I told you the government could take a huge chunk of what you leave behind? Even after a lifetime of paying taxes? Yep, that dream house, your retirement savings, your family's security could all be up for grabs. But here's the thing. Not everyone pays estate taxes, and whether you do depends on one surprising detail that most people overlook. Stick around, because if you think estate taxes are only for the ultra-rich, you might be in for a shock. Number 1. What is the estate tax, anyway? Let's start simple. When someone passes away, everything they own, their house, cars, savings, investments, jewelry, even the family business, becomes part of what's called their estate. Now, the estate tax is a tax on the total value of that estate before it's passed on to heirs. It's sometimes nicknamed the death tax, which, let's be honest, sounds like a villain from a superhero movie. But in reality, it's just one more way the IRS gets involved, even after death. Imagine you leave behind a house worth $600,000, a retirement account with $1 million, and other assets totaling another $400,000. That's $2 million in total. Now you might wonder, will your family have to pay estate taxes on that? Well, that depends on something very specific. The estate tax exemption. Number 2. How much can you pass on tax-free? Here's where things get interesting. As of 2025, the federal estate tax exemption is around $13 million per person. That means if your estate is worth less than that, the IRS takes nothing. Zero. If you're married, you can double that. Your combined estate can be around $26 million before the federal government steps in. So if your estate is under those limits, you're in the clear when it comes to federal estate taxes. Now, you might be thinking, great, I'm nowhere near $13 million. So I'm safe, right? Well, maybe, because this is just the federal level. The real curveball, some states have their own estate or inheritance taxes. Number 3, watch out for state estate taxes. Even if you don't owe federal estate taxes, your state might still want a piece. Currently, over a dozen states in the USA have either estate taxes, inheritance taxes, or both. States like Massachusetts and Oregon have some of the lowest exemption limits, around $1 million. That means if you live there and leave behind an estate worth just $1.2 million, your heirs might face a tax bill. Let's say your modest home appreciated to $900,000. You have $300,000 in retirement funds and a paid-off car. Boom. You're suddenly over the limit. Surprised? That's how many middle-class families get caught off guard. Knowing your state's rules could save your heirs thousands, or even hundreds of thousands, in taxes. Number 4. Estate tax versus inheritance tax. What's the difference? Here's a common point of confusion. Estate tax is paid by the estate before the assets are distributed. Inheritance tax, on the other hand, is paid by the people receiving the inheritance. It's like the estate is paying the government before giving out your stuff. And then in some states, your kids might have to pay again just for receiving it. Brutal, right? States like Iowa, Kentucky, Maryland, Nebraska, and New Jersey have inheritance taxes, but the rates and rules depend on who's inheriting. For example, in some states, close relatives like spouses or children are exempt, but more distant relatives or friends might have to pay. So who inherits matters a lot. Number 5. What happens if you owe estate taxes? Let's say your estate does exceed the exemption. What happens then? First, the executor, that's the person in charge of settling your estate, has to file an estate tax return. They also have to come up with the money to pay the tax, usually within 9 months of the person's death. And here's the kicker. Estate tax rates are steep. We're talking up to 40% at the federal level. That's right. If your estate exceeds the exemption, everything above that amount could be taxed at rates as high as 40%. So if your estate is worth $16 million and the exemption is $13 million, that $3 million overage could result in a tax bill of over $1 million. That's not pocket change. Number 6. Common assets that push estates over the limit. You might be wondering, how do people even end up with estates over $13 million? You'd be surprised. It's not just billionaires and celebrities. Here are some common assets that can quietly inflate your estate's value. A home in a high-cost city that has appreciated over decades. Life insurance policies. Retirement accounts like 401(k). S and IRAs, stock portfolios, family-owned businesses. Let's say someone owns a successful landscaping company worth $3 million, has a home in California worth $2 million, and a $2 million life insurance policy. They're already at $7 million and counting. Throw in savings, vehicles, and other investments, and you're climbing fast. Estate values add up quickly. Number 7. Smart ways to reduce estate taxes. Now for the good stuff. If you want to reduce or eliminate estate taxes, there are legal strategies that work, and you don't have to be a billionaire to use them. One powerful method is gifting while you're alive. You can give away up to $18,000 per person per year as of 2025 without triggering any gift taxes. That means a couple can give $36,000 per person per year to their kids, grandkids, even friends. Over time, this lowers the size of your taxable estate. Another popular tool is irrevocable trusts. Let's say you put $2 million into a trust for your grandchildren. That money is removed from your estate, and the trust owns it now. Or maybe you set up a charitable trust, which lets you donate to a cause you care about while getting significant tax benefits. Even family limited partnerships or grantor retained annuity trusts, GRATs, can freeze the value of assets and reduce future tax exposure. And don't forget life insurance trusts, which help keep the death benefit out of your estate while still supporting your heirs. Sounds complicated? It can be, but that's why working with an estate planner or tax attorney is a game changer. Number 8. What if you do nothing? So what happens if you don't plan at all? If your estate owes taxes and you haven't prepared, your heirs might be forced to sell family assets just to cover the tax bill. Imagine your kids having to sell your vacation cabin, liquidate your retirement accounts, or break up a family business just to pay Uncle Sam. And it doesn't happen in months. It happens fast. Estate taxes are due within 9 months, and delays come with interest and penalties. Planning now can prevent a fire sale later. Number 9. Estate tax rules are changing. Here's something most people don't realize. The current exemption, around $13 million, is temporary. It was created under the 2017 Tax Cuts and Jobs Act, but unless Congress acts, it's set to drop significantly in 2026, possibly down to $6 or $7 million per person. That's less than half. So, someone who's safe from estate taxes today might not be tomorrow. Planning ahead now could save your family millions in the future. Number 10. Don't wait until it's too late. Estate planning is one of those things we tend to push off. It feels far away, uncomfortable. But if you care about what happens to your family, your home, your legacy, it matters. The earlier you plan, the more tools are available to you, and the more time your assets have to grow and be protected. Think of it like this. You wouldn't build a house without a blueprint. Why leave your life's legacy without a plan? Number 11. Your will does not avoid estate taxes. Many people believe that writing a will is enough to protect their estate from taxes, but that's not true. It will simply tells the court how to distribute your assets. It doesn't reduce the size of your estate for tax purposes. So even with a will, your estate might still owe taxes if it exceeds the exemption threshold. Let's say you leave everything to your children in your will. If the estate is worth $15 million, the IRS will still expect its share on anything above the exemption. It will help with clarity and distribution, but it doesn't provide tax shelter. That's why using tools like trusts and gifting strategies are essential for effective tax planning. Number 12. Life insurance can trigger estate taxes. This one surprises a lot of people. If you own a life insurance policy on yourself and die, the payout goes to your beneficiaries. But, and this is big, if you own the policy, the death benefit is included in your estate's value. So if you have a $5 million policy and your estate is otherwise worth $10 million, your estate is now $15 million. That could push you over the estate tax limit. A common solution is to transfer ownership of the policy to an irrevocable life insurance trust, ILIT. This way, the payout avoids being included in your taxable estate. But this move needs to be done carefully. If you die within 3 years of transferring the policy, it could still be counted. So planning early is critical. Number 13. Even debts and funeral costs don't always help. Some people think that debts and final expenses will significantly lower the estate's value. While it's true that estate debts and funeral costs can be deducted from the estate's total value. It's often not enough to drop it below the exemption threshold. Let's say someone has an estate worth $14 million and leaves behind $500,000 in debts and expenses. Even after deductions, the estate is still $13.5 million, which is above the exemption. So while deductions can help, they won't eliminate estate taxes if you're way over the limit. You still need solid planning. Number 14. Business. Owners are especially at risk. If you own a small business or farm, estate taxes could be a big problem for your heirs. Businesses often have high asset value but not a lot of cash on hand. That means your heirs might be forced to sell the business just to pay the tax bill. It's a tough spot, and it happens more often than you'd think. Fortunately, there are estate planning tools made specifically for business owners. You can set up succession plans, use special trusts, or take out life insurance to help cover future taxes. The key is starting early, before the IRS shows up with a bill your family can't afford to pay. Number 15. The power of portability. For married couples, here's a benefit many couples don't use: portability. If one spouse dies and doesn't use up their entire estate tax exemption, the surviving spouse can elect to take over the unused portion. This can double the exemption for the surviving spouse, up to $26 million combined. But, and this is important, portability is not automatic. The executor of the first spouse's estate must file a special estate tax return, even if no taxes are owed. If you skip this step, the opportunity is lost forever. So if you're married, portability can be a huge estate tax advantage, but only if you plan properly. Number 16. Special breaks for family farms and closely held businesses. The IRS does offer some relief for family-owned farms and closely held businesses. If certain conditions are met, your heirs can pay the estate tax over time, up to 15 years, and, in some cases, they can even value the property at its current use instead of market value, which can reduce the tax. This is especially helpful for families who want to keep a farm or business running across generations. But the rules are very strict. One small mistake could cost your family the ability to claim this break. It's one more reason why working with an estate planner is so important. Number 17. Don't forget about step-up in basis. There's one big tax advantage in estate planning that often gets overlooked: the step-up in basis. When someone inherits property, the value of that property is stepped up to its market value at the time of the original owner's death. So if you bought stock for $10,000 and it's worth $100,000 when you die, your heirs get a new cost basis of $100,000. That means if they sell it immediately, they owe no capital gains tax. This is why holding on to appreciated assets until death can be more tax efficient than gifting them while alive. Estate planning isn't just about estate taxes. It's about total tax impact. Number 18. Estate planning isn't just for the wealthy. Here's the bottom line. Estate planning and thinking about estate taxes isn't just for millionaires, middle class. Families with property, life insurance, and retirement savings can easily reach the limits in certain states. And even if you don't owe taxes today, changing laws could affect your family in the near future. The earlier you start planning, the more options you have to protect your legacy. It's about peace of mind, knowing your loved ones will be taken care of. And here's the question I'll leave you with. If something happened to you tomorrow, would your family be protected from unnecessary estate taxes or left scrambling to pick up the pieces? Let me know your thoughts in the comments.